Good morning. Last week we discussed several things. Out of that, we did the accounting rate of return, then time value of money in PV, and we started IRR. Hope you can remember the things. Let me show you. We did the NPV. This is the future value of money. Future value is equal to present value 1 plus I to the power n. Right? N is the number of years. So accordingly, we calculated NPV for the project A, then to the project B, right? Wherever NPV is larger, that means larger positive value, that project we take as the best project. We have to, we are comparing several projects. Whichever gives the highest value of NPV is the best project. So advantages are NPV, we are considering the cash time value of money, take into risk consideration, and we consider entire project lifespan. Disadvantages are NPV is difficult to calculate. Let me go back to the board. Right? What we did, you have a project, then we have initial investment, then we have returns R1, R2, R3, R4, return 4, Y1, Y2, Y3, Y4, Y0. So under NPV or net present value, what we do, we bring the return value to today's value. R1 to today's value, R2 to today's value, R3 to today's value, and R4 to today's value. We bring the value to Y0 because Y0 is the year where you are doing the investment, right? So the formula we use be future value equals present value into 1 plus I to the power n. So present value equals 1 divided by 1 plus I to the power n into future value, right? This factor is called discounting factor, right? So present value of R1 equals 1 divided by 1 plus I to the power 1 first year into R1. Present value of R2 second year is 1 divided by 1 plus I to the power 2 into R2, right? So similarly, we bring everything together. Then we add up present value, total present value equals present value R1 plus present value R2 plus present value R3 present value R4. So we add up. So it is like we can write it as sigma n equals 1 to capital N 1 divided by 1 plus I to the power n into future value R, present value. This is the equation we use. In Excel, it is very easy to get this, but this is the theory behind it. So in the exam, if we give you a question, always we will give the discounting factor, which is 1 plus I to the power n, discounting factor. If it is 10% discounting, 1 plus 0.1 to the power 1, which is 0.9090, something like this. So always institute will give you the discounting factor. You don't need to do all these things. They will give you the discounting factor. You multiply it with the return where you want to bring it to the day one, right? So net present value equals this one, sigma n equals 1 to capital N, 1 plus I to the power n into future values n minus I, right? That means you bring all the future values to today's value and subtract that with the investment, because all these are profits they earn, this cash flows they earn, and this is the initial investment. When this is positive means, right, the future expected cash flows present value is greater than I. Present value of future returns is greater than initial investment. That means it is good. If this is other way around, present value of future all expected cash flows is less than the initial investment, no point doing the business. You just hold the money with you, right? You hold the money with you. Don't need to do a project. Otherwise, it's a waste of time. You invest 10 million today. Even after 10 years, you can't get the money you invested. That is the meaning of this one, right? So, this is the NPV, net present value, right? When you have project A and B, that means you have R1, R2, R3 for project A. Then you have another set of returns for R2. You will look at the present value for project A. You will look at NPV for project B. Whichever is higher, you take as the best project. Whichever is higher, you take as the best project, right? So this is the NPV, net present value. So you consider time value of money, right? You consider time value of money here. We consider entire lifespan of a project. You consider all the risks in here. However, this is not easy like what? Payback period, ARR, they are easier, but this is difficult. Then we have something called IRR, internal rate of return, right? This is the discounting rate where NPV of a project equals 0. This is the discounting rate return where the NPV equals 0. NPV is 0 and interest rate, right? Discounting rate, right? So in this scenario, in order to find out IRR of a project, you need to calculate NPV minimum of 3 times, right? You have to calculate NPV minimum of 3 times, right? What you do, you find the NPV, you do a ballpark figure, you do a guesswork, you find take the interest rate, discounting rate. We say it is 20. Arbitrary, you take 20, right? Then apply it to the NPV formula and find out the NPV value. right? We need to find out two figures. We want to find out discounting rate 1, where NPV is positive but near 0. Positive NPV V1, which is positive value, right? This is not present value, this is positive value. Then you need to find out another NPV in discounting rate I2, which gives you NPV negative, right? You have to find out two discounting rates. In one discounting rate, NPV of the project is positive but near 0. Other discounting rate, when applied, NPV is negative but near 0. Right? Positive, I positive, I negative. Positive 1, 2. Right? So we need to find out these two rates and these two values. Okay. So you do a initial work, put this 20 into this formula. I1 plus I2 minus I1 divided by positive value plus absolute value of negative value into positive value. Right? This is the value. Interest rate where NPV is positive but near 0. I2 is the discounting rate where NPV is negative but near 0. Positive value, negative value, right? I1 plus I2 minus I1 divided by positive value plus absolute figure, just the figure, not the negative sign of the negative value into present value, positive value. So this is the formula. So you apply I20, find out the NPV. We say it is positive 3000. Example, when you apply 20%, NPV is positive 20,000. So you can take I1 as 20. Then what you do, you give 25%. Then you find out NPV. This becomes 4,000. That means NPV, sorry, right, I was working here. You can see this place. You are 20%. Find out NPV. So it is 3000. Right? So you can take I1 equals 20%. Right? Now you apply 25% to NPV. Then it comes to 4,000. Right? That means NPV which was here has gone up. We want to find out this one. NPV is 0. This is the interest rate. This is the value. Right? This is the value. On this line, it is interest rate. So you took I1 which is 20%. When you did 25%, this has grown. NPV has increased. This is the NPV. NPV has grown. Right? You want to find out the interest rate somewhere here. Right? So instead of 25, you apply 50. This is going on this side, so we are going on the wrong side. So you have to bring down the interest rate 15 NPV. If you are lucky, you will get a minus 1,000. That means here, somewhere here. 50% is minus 1,000. Negative, but near zero, right? When you put 15, if it is positive 1,000, you will have to put another one. This coming down, that means you are in the correct path, but this is too small, right? So you get a negative value here. So this is I2 then, right? So on this formula, 20 plus I2 is 15 minus 20 divided by positive value is 3,000, negative value, absolute term of negative value is 1,000. This is into positive value 3,000, right? So it is something below 20. See, 20, it has to be below, because we want to find out where in discounting rate where NPV equal to 0, right? This NPV is 0. NPV is 0, right? So it is discount. So IRR is the rate at which NPV equals 0. In order to find out IRR of a project, we calculate using this formula. I1, which is the discounting rate where NPV is positive but near 0. I2 is the discounting rate where NPV is negative but near 0. Then we take the two interest rates, then we take the values, positive value as it is, and the absolute term of the negative value. That means we forget about the negative minus 1,000, we forget about minus, we just take 1,000, right? So that way we can calculate the IRR, right? We can calculate the IRR. So whenever you have few projects to compare, right, we will find out the project with highest IRR as the best project. Project with the highest IRR as the best project, right? Therefore, when we go to this thing, so project A, you calculate the IRR using that formula, you get NPV A at 29,000. Then you put 30, it is negative 8,000. So you find out using I20, I30, what is the IRR, which is 25%. Right? Then for project B, use 20, you will get 3,000 here. Then 25, you get negative 7,000. So when you work out, IRR would be 22,000. When you are comparing the two projects, IRR of project A is 25, IRR of project B is 22. So project A's IRR is higher. That means we select project A as project A gives the highest IRR. It considers time value of money. Cash flows over the entire project life is considered. Disadvantage, IRR will not give correct decision when the project lives are unequal. See, only time we don't consider the project life is payback period. Payback period, what we consider is time taken to recover our initial investment. After that time, we don't bother. All other cases, you need to consider the project life. Right? IRR is difficult to calculate. So when you use all four, we could not, the ARR for both projects came equal. Payback period A, NPV method, it was A, IRR, it was A. So our best project out of the two projects is A, right? These are the different financial risks we have. We have credit risk, which is whether will I get my money back. Market and industry risk, what is the risk from the industry. Operation risk, which is the risk associated when operating a project, frauds, those kind of things. Reputation risk, by what kind of a reputational damage it will cause. Liquid risk, that is short-term liquid position of the business, day-to-day funding for the day-to-day operation. Legal risk, is there any legal barriers for the project, like our land law, right? We have restricted foreigners to buy lands in Sri Lanka. So that is a legal risk. So these are the risks associated in conducting a project. Okay, thank you. On this slide, now we will discuss 6 C's of credit. Right? When you are looking at a project, right? When you are evaluating a credit, most important aspects to look at, whether this is a consumer credit, that means retail, you and me type of credit, or like we have two things, right? Consumer credit and commercial credit. Consumer credit is the credit where the funds will not generate additional profits. Whereas commercial credit, the funds given will generate additional profit. We will shortly look at it, right? So whether it is consumer credit or commercial credit, how a bank will look at this project initially starting, right? We look at 6 C's of credit. We say 5 C's, we say 7 C's, but under your syllabus, it is 6 C's of credit. What is the most important aspect when you are looking at giving a facility? See, granting credit and the marriage both are almost equal. Time taken to grant a credit is 2 minutes. To marry it is only 2 minutes. You sign, you pronounce the name, you are married. Right? Grant, you say approved, facility has been granted. But preparation to grant the facility or preparation to marry take larger amount of time. And again, if the preparation and selection of person is wrong, you will be in trouble both in credit and marriage. Right? So what is the most important aspect we have to look at when considering for marriage? Think. It is the same for credit. It is the character. We look at the character of a person before anything when you are thinking of a marriage. Not the beauty of the face, not the color of the skin, not the family background, not the vehicle he or she comes in, but the character. If your most important thing is the character. So the credit also look at the character of the customer. How do we look at it? It is the first thing. First is character. Crib. Very good customer, but in crib. No, you can't. If the customer is good, you pay loans, you pay the banks, right? You eat every day. Whether you have money or not, somehow you try and eat. So if the customer is good, he somehow pays the bank, right? Even if he goes bad, he will come to the bank and reschedule and repay. He wants to repay. Right? We want that kind of people. No areas. Somehow they are paying. So character is purely judged, mainly judged by the crib reports. And the people they are associated with. People whom they have recruited. Right? So most of you are into credit. So you know, if the crib is green, that means they are paying very well. So you are happy to lend. Then yellow, that means 1 day, 2 day, 3 day, 5 day areas. Then you are little conscious. Then the red NPL comes in. You don't like to, because history repeats. If he does that somewhere else, he will do the same to us. So character is the most important thing, and crib is the mirror to look at the character. Right? Will the borrower pay? That is character. Can the borrower pay? Will the borrower pay? It is the character. Will the borrower pay? Can the borrower pay? It is capacity. Capacity. We find out the ability of the borrower to repay. Today I can pay only 5,000. If you give the loan, I will pay 500,000, right? That can't happen. Businesses grow gradually. It won't grow like this. It will grow like this, right? So you have to be careful. If the customer can pay at least 50 to 60% of the loan what he's asking, then we are good to go, right? In order to do that, we calculate something called DSCR, debt service cover ratio. We learn this. Profit before interest and depreciation divided by capital, term loans, interest, term loans and short-term loans, plus lease rentals minus tax, statutory, right? Term loan wala capital leka, interest, term loans and short-term loans, then lease rentals. We calculate DSCR, debt service cover ratio, profit before interest and depreciation minus tax. This is for long term funds. If it is short term facility, it is interest cover. Interest cover, which is equal to PBID minus tax divided by interest, term loan interest, short term loan interest plus lease interest. Right? This is called interest cover ratio. Right? Debt service cover ratio and interest cover ratio for short term facility. Will the borrower pay? Can the borrower pay? Right? Then third one is capital. Third one is capital. How much? Third one, capital. How much borrower has invested in the business? This is required for two things. First one, commitment. Second one, to see the cushion for operational levels, right? Say you have business. Your business won't go like this. It goes this way, right? If your monthly commitment is like this, at this point, business will not be able to pay you, right? If your monthly commitment is something like this, though the business comes down, you are better off, right? So we look at capital invested, the money invested by the sponsor. We have discussed about two things. First one, equity capital and debt capital. How much the investor, the promoter has invested on the business. That is the money invested, right? Why we look at the money invested by the sponsor is to see the commitment. If I don't have a commitment to a business, I will not put my money. I will always ask the bank to put everything, right? Therefore, in order to check the commitment, we look at the capital investment, and the second one is business will not grow like this, it will fluctuate. So if under downward fluctuation, if the money invested is very big or large amount of the business has been invested by the bank, that means debt capital, slightest drop in the business will affect the operation levels or the repayment levels. If other way around, so true, when the amount invested is by the equity capital is high, your commitment will be lower, so drop in sales will not affect the commitment, right? So that is the two things: capital funds, debt capital and equity capital. Demonstrate the ability and willingness to invest personally in the business. That's the commitment. Low debt obligation create room for servicing debt under an adverse condition as well. Then the conditions. What do you mean by conditions? Here the condition does not mean the conditions the bank put forward or the society put forward on the sponsor, right? It is the condition of the business environment. These days, if someone comes and asks me, I want to start a ticketing business, will you give money? No, I don't think you will give, right? Just a normal person want to start a new ticketing office. No, you will not give. Why? The market is not sure. We don't know when Suddhas will come here. We don't know when we will be able to go out. So the demand for tickets will come down. So we are reluctant to assist the tourism business, right? Condition where the business is in. If these days someone comes and asks for the construction, road construction, yes, I may consider. Why? Because it is happening again. Paddy, yes, we will consider, right? Like that. So condition where my business is in, that is the condition, not terms and conditions. The bank will consider all of the environmental conditions such as competition, growth, location, economic outlook in which the business will operate. Then fifth, C, that is the collateral or the security. Worst case scenario, also we need to collect the money. Worst case scenario also, we need to collect our money. So that is the second way out. First way out on all business or any business, it is the cash flow of the business. But if the cash flow fails, you have to recover the money. You go behind the security. So collateral comes as the second way out. Ability to resell the security and collect our money. Bankers are not so landed proprietors. We just don't want lands. We want our money back. That is 5 C's of credit. 6 C's of credit. 6th C is cash flow. Just keep in mind, they may ask cash, they may ask for uh, everything, right? So cash flow is the 6th C. The bank will want to know whether sufficient cash is generated by the entity, enabling them to service all their obligation, including debt obligation. That is the net cash position. Cash inflows and cash outflows. Right? You see the figure 1, cash inflows, and if the cash outflow is smaller, you have a cushion. Right? 5 C's of credit: character, capital, capacity, character, capital, capacity, condition, collateral, and cash flow. Right? So these are the things. Don't mix up this cash flow. Sometimes they will ask what are the 6 C's of credit, saying cash flow. Instead of cash flow, they'll say cash. Right? So you have to be careful in answering. Right? Thank you on that as well. So this is our 10th lecture, no? And we look at the retail and corporate credit evaluation and assessment. Credit major categories: consumer credit, commercial credit, and development credit. Consumer credit, as I told you earlier, personal loans, short term, medium term, mortgage loans, those are housing loans, personal loans, housing loans. Commercial credit, it is the funding given for day-to-day working capital. Development credit, which is the microfinance and project financing. Microfinance, microcredit, and project financing. Then you have project financing, right? International trade credit, consumer credit, commercial credit, development credit, and international trade credit. That is LCs and discounting of LCs and those things. Retail consumer credit evaluation. So this is the 6 C's what we discussed. Right? 6 C's of credit. Then we use this papers. This is a model. We look at the purpose before lending. Purpose of the facility request, the amount they have requested, whether they are in a position to repay. Purpose, what is the purpose they are in? What is the purpose they need money? The amount they need, period they need. We want to work out the repayment. Purpose, amount, period, expertise, which is character, commitment, capacity, repayments, and security. Papers. purpose, for what purpose they want money, the amount, how much they want, for how long they want, expertise, what are the expertise. Under this, they will look at the 5Cs again: character, commitment, capacity, all those things, right? Expertise and those things. Then repayment and security. How much can they repay? What is the cushion on repayment? And lastly, but not the least, the security. What is the security available for my facility? Then we have another variation from 6Cs, which is passer. Earlier one was papers. This is passer. Person. Who is the person? We are looking at character again. Person. The amount they are asking. Repayment, the ability to repay. Security, what kind of collateral they are giving. Security, expediency, business customers, suitability, whether they have experience, right? Expediency, that is the experience and ability and those things. Remuneration, the amount of money it will generate. Amount of money they will generate. Person, amount, repayment, security, expediency, and remuneration. Then we have Campari. This is very, very critical. Institute used to ask 6 Cs of credit and Campari alternatively. Campari, again, derivation of 6 Cs: character, ability to repay, margin, what is the interest rate, what is the margin available, purpose, what is the purpose of the facility, amount, how much they need, our repayment period, insurance, it can be insurance per se or security. Insurance stroke security. In security also considered as an insurance. Campari, character, ability, margin, purpose, amount, repayment, and insurance. So that is the other variation. 5 Cs, 6 Cs of credit. First one, papers, purpose, amount, period, expertise, repayment and security. Second one, passes, person, amount, repayment, security, expediency, and remuneration. Campari, character, ability, margin, interest, purpose, amount, repayment, and insurance. This is the most important model in finding out the ability to repay, right? Then we have corporate credit. Corporate credits deals with business, whereas consumer credit deals with day-to-day our own funding requirement, right? We look at the funding. So we need to look at corporate credit. It is the businesses and projects we are going to look at. So corporate credit, we discussed the consumer credit where we are looking at the individual person. So whether it is corporate credit or consumer credit, 6 Cs is the key process, right? So there are variations from 6 Cs. Under the corporate credit, we will discuss a MIFID, MIFID, right? It is another 6 pillars of credit. We will be discussing, looking at management, industry or the market, financial quality, financial analysis, environment. It is legal environment, political environmental, regulatory, social, economical, and technology, different environments. Risk and mitigates, terms and conditions. This is the MIFID model. So as we discussed earlier, for consumer credit, we have papers, then we have passer, and we have Campari. These are the models we used when you are looking at the retail credit or consumer credit. What does the consumer credit means? Funding which will not generate any new income or profits. But commercial credit is funding where the investment will generate new income, right? Corporate credit, so management and operation, competitiveness of the management, right? Management ability, formulate and execute the strategy, responsiveness to the environment. Because, see, in the management decisions, you need to have qualified people as well as experienced people. You can't just run an organization with qualified only people. Or you may not be able to run an organization with just experienced people. Why? Qualified people are not practical. They have not faced the day-to-day environment. On books, yes, we know everything. But when you jump to the sea, only you know how to swim. From the book, you can't decide how to swim. We can teach, right? But you need to have the practical experience. When you have only practical people or the experienced people, they don't have the depth because they have learned everything on their own and with experience. New developments and those things and new techniques and those things, they may not be aware. So it has to be a combination. When you are evaluating a business, access to the key management people. Like you go into a business, but you hardly meet the directors, always the low end. Then you have a problem. Because we need to know proper situation of the business. Right? Then the directorate, it is very important. Like the owner or the directors should be knowledgeable about the business. Otherwise, what will happen? They will have to depend on someone else who is a third party. Right? Tea factories, larger amount of tea factories are making problems. Why? Owners, wealthy people, they invest on the tea factory and give the full control to a factory manager. Suddenly he vanishes, owner is in trouble. So directorate expertise in relevant fields and sector is very, very important. Then the labor turnover. Human resource is the most critical resource. If the staff start going out, we can't run a business properly. ownership and legal structure we have to look at. Why are we looking at all these things? Qualified people, experienced people, directors' ownership, whether they can create strategy or whether they can implement the strategy, have the experience and successful in the past. Why we look at all these is when the negative position starts, we have to have people who can shoulder. If the management is not strong, in a negative position, business will collapse. But with experienced people, qualified people, knowledgeable directorate, any downfall can be saved. Analysis of the market. As we discussed earlier as well, market is a critical factor. So you have to analyze the market structure. Under this model, we are going to analyze the market structure, identify and define the market, government policies, regulations, competitive positions, from imports, is there any threat from the imports? Can you replace the imports? All those things. Specific marketing arrangements. Who is handling the marketing function? What is the market share of this business? Expected industrial growth during short term and the long term. Very short term, 12 months. What will happen in the next 12 months? Global market trend. When the corona started, they started telling black tea is good for prevention of corona. So our tea industry saw a boom. So do we have something like new market trends? All those things we need to look at the market. Financial analysis, companies' historical performance, what are the margins, ratios, those things, what are the bank facilities they have, do they have enough credit lines to fund the working capital part, then all the ratios what we discussed, liquidity, leverage, profitability ratios, we have to look at. All those things we discuss. So under this model, we look at all these things, right? Leverage and gearing ratios, time interest, EBIT, profitability ratios, projection of financial condition, pro forma projection of the, like we analyze the past, we know the present, and we project the future. Then cash flow projection, then how much cash we need to borrow, loan repayments and those things. And projections determine the critical and non-critical assumptions. Right? Because all assumptions are made to project the future. Then we go on a pro forma P&L, balance sheet, and a cash flow statement. Environmental analysis. Can you find a word on that? We call it PESTLI analysis. We look at the macro environment, right? Not the micro. Micro environment is the company. Macro environment is evaluated using PESTLI. What does PESTLI stands for? Firstly is political, economical factors, social factors, technical factors, legal factors, and environmental factors. Pestle, Pestle, right? So, what do you look at political? Like the entire stability of a business environment depends on the politics. If the political situation of a country is not stable, then the business economics, business environment is not stable. Right? Will this business be affected due to political change, due to new political factors coming in? Then the economical factors, like if it is a export market, import base, if the economy comes down, no restrictions like this, how can the industry survive? Right? Social factors, we discussed these factors not last week, can't remember. Yeah, last week or prior. Social, what is the impact to the society? Job creation, wealth creation, market development, all those things. Technical factors are what is the production methodology we use, what is the technology we want, what capacities, what infrastructure, what power, all those things comes under technical. Then the legal. Legal factors look after the new legal legislations which may come in during the tenure of the project. As example, land bill of the country, legal issues. Then environment. It is the solid, liquid, wastewater and fumes. Right? So air pollution, soil pollution and water pollution. All those things you have to look at. Risk assessment and mitigation. Credit risk. It is twofold. When the bank gives money, will the customer pay? We do all these things to find that credit risk. And the customer's credit risk. Customer is giving out goods, selling goods on credit. Will he be able to collect the money? Management risk. What is the dependency on the management? Industry risk. What are the risks arising from the industry itself? Right? Now, think about, we don't, like meat shops, right? Meat shops. Now we are talking about banning slaughterhouses for cows. What will be the impact to the industry, business? Structure risk. Are we giving a long-term loan for long-term need and a short-term loan for short-term need? Okay. Other risk as applicable. Everything is a risk, right? Construction, delay payment, robberies, and all those things are risks. So you can address based on the project you have. Security and terms and conditions. Covenants or terms and conditions, what are they? Those are the conditions we put forward to maintain the same level of risk which prevail today to the 5 years during the tenure of the loan, right? These are conditions we put forward to a customer in order to maintain the same risk level of the customer for the tenure of the period. They are positive or affirmative, negative or positive, affirmative and negative, third way, restrictive, negative or restrictive covenants. Positive covenants, we get the customer to adhere to. We don't restrict the customer. We will ask the customer to do an insurance, which he can adhere to. But negative covenants, we restrict the customer. You can't borrow. You can't invest. Like that, you restrict the customer. So those things are called negative covenant. This is an example for that. Right? Right? It's an example. Negative capital outlay, that is the investment, cannot be more than this. Cash dividend cannot be more than this. Cannot be. Whereas affirmative, borrower must maintain. Just 1 minute. Borrower must maintain a current ratio, debt equity ratio. Certified financial should be given within 30 days. Like that, we put the conditions, which can be adhered to. It is not restrictive. We ask the customer to adhere. Security. Security forever. Easy to, any security should be easy to value, valuable, easy to charge, realizable. Ever. Security is forever. Easy to value, valuable, easy to charge and realizable. Easy to value. As a general rule, current value of the collateral must be significant margin over the amount of advance. If you are giving a loan, always the current value of the security should be more than the advance. Assignment risk. Right? So when time passes by, risk increases. When with time, risk increases. Right? Like when you buy a bus today, the risk is very small. But when time passes, risk increases. See? Right? Because maintenance comes, wear and tear comes, so risk increases. So always when in lending, when you lend, if it is 5 years, 10 years, so 3 months, this is low risk, medium risk to high risk. Right? Because with time, non-payment of the loan will increase. Right? So why we need security? Security is second way out. If the customer does not pay, we have the psychological advantage of taking over and selling the security. Right? So in this scenario, we say always security value should have a margin over and above the risk or the facility. So it has to be going like this. Security value also should rise with time. What are the rising things? Land only. Land and building, value rises. But Toyota cars also value rises in our country, not in any other place in the world. Right? So sometimes value may be the same. Or it may be reducing. This is land, cash, land, cash, machinery. These are three types. Increasing value securities, decreasing value securities, stable value securities. Right? With time, risk increases. If you take a reducing value securities, with time, we are in the trouble. So, always it can be a combination or it has to be this. We say type of security, that is decreasing value security, stable value security, increasing value security, stable value security, and decreasing value security. Type of security should always link to the type of the facility we grant. Right? So you have to look at that. Best practice is to relate the nature of the collateral to the nature of the risk. It is short-term risk, reducing balance is okay, fluctuating balance is okay, like that we can have. But if it is long-term, then we have to look at the structure, the nature of the security. Then non-financial tool, SWOT analysis. SWOT, all of you know that. Strength, weaknesses, opportunities, and threats. That is a very micro analysis. This look at purely on the perspective of the company. Right? So it is a micro analysis of the business. Right? Is the SWOT. So we have strengths, weaknesses, opportunities, and threats. It will allow us to focus on the strength, recognize the limitations, and develop opportunities. Focus on strength, recognize the limitations, and develop opportunities. It is an easy function. Right? Strength, suitable for the present. Resources and capabilities that can be used as a basis for developing competitive advantage. See, I have very good, capable staff. Then it is my strength. I have high technologically advanced machinery. It is a strength. You are well in advance, very good advanced technology use. So your rejection may be lower, quality may be higher, strength. But on the other side of the strength is the weakness. Not favorable for the present. Weakness may be the flip side of a strength. Yes, I have very good, capable, and experienced and qualified staff. Weakness is what? Your salary cost may be very high compared to industry. I have huge machinery with all success. Risk is what? You may not get experience, people. Right? So, strengths and weaknesses. Flip side of the strength is the weakness. So, bringing for example, state of the art machinery you have. You all money invested on machinery. Now you don't have money for the working capital. So is it the strength or the weakness? Strength, but it has the flip side, creating a weakness as well. Opportunities. That is the opportunities available in the outside market, external market. What is the opportunity you have at this moment of time? Everything locked up. Right? What are the opportunities? Anything produced in the country. Instead of an apple, let pears be popular among us. Right? It is the external environment. See the opportunity. Right? When COVID came in March 2020, we had to close all the shops. Online business started booming. Door-to-door delivery started booming. Right? So those are opportunities. But you have to capitalize on the opportunities. So you have to look at development in science and technology, change in the market on both national and international level, changes in the government policy, maybe in the industrial sector, changes in the government policies, industrial sectors. See, now if you are into construction, you will have a better chances of getting new projects. Changes in social patterns. Like, say, our population is aging. What is the benefit you can think over? What is the benefit you can think over? What? Aged care facilities. Do we have it here in Sri Lanka? No, we don't. So, if someone is investing in aged care, that will have a bigger impact to the society and the income. Right? Mergers and joint ventures, unfulfilled brand, customer needs. See, when your income level changes, your needs and wants also changes. So, do we have a branded shop here around? So, when your middle income goes up, your requirement changes. See, very suddenly our cocoa exports to China increased. Why? Why? Chinese middle market was increasing, right? Whoever slept on the floor now has started to sleep in on a mattress. So they have to build mattresses. The easiest is to get the coir, rubberize, and make the mattress. So the customer need has created a demand for this product. Opportunities to add value. Just don't send as raw material, add value to the business. Threats, change in demands. What can you say? Walls ice cream. How many of you can remember what is walls? Do we have walls now? No, we don't. Kagi's magic is the walls. Right? Demand patterns changes with time. Right? Clothing, same cloth patterns, you can't have it both. For male, it is only the shirt and the trouser. But for a girl, your patterns changes daily. So we have to look at those patterns. Then emerging technology we need to have. How bulky was our TVs? Do we have those things now? No, we don't. Right? Cameras, film rolls. How many of you has used a camera with a film roll? I don't think many. Right? So, mobile phones. See how fast the mobile technology changes. Every other year you may be changing your mobile. Why? The technology changed, new models came. So you can't have stocks with larger amounts. Government subsidiaries, right? Or taxes will affect the industry. So those are threats to the business. So we have to look at threats. So we look at the strengths of a business. This is a micro analysis, right? You look at the strengths of the company and the weaknesses of the company. Strengths in order to capitalize on that. Weaknesses in order to protect. Then you look at the external factors. Opportunities. What are the opportunities I have? And what are the threats I will face? So, SWOT analysis is a micro analysis. Bestly is a macro analysis. Right? So you have to look at those things. Bestly, I explained to you this the Paisley analysis: political, economic, social, technological, legal, and environment. Political pressure is a very, very tough pressure. Sometimes, like some this businesses has to close down from countries and leave. Then social pressure also the same. Okay, I'll give you example. In India, Coca-Cola had to leave once. Right? Coca-Cola came in and they have to leave. Why? There was a very strong movement made in India, be Indian, buy Indian. Right? So they had something called thumbs up. So this movement pushed Coca-Cola to leave from India. So this is social pressure. Right? In countries like us, when we are talking about increasing the milk production, one factor we have to look at is what are we going to do with the cows when they are old, when they are not giving milk? Can we produce beef? No, you can't. We have cultural difficulties in order to do that. Right? Forget about religion. It's not religion, it is culture. Right? Why? It is not because of anything. It is the cow has helped us a lot. That's why we try to protect the cows. That kind of thing. So you can't have beef factories in Sri Lanka. I don't think you will ever have beef factories in Sri Lanka. Right? So those things are sociological. Technological, new technology improvements, technology, legal frameworks, and the environment. Global environment. Dakkan is to Suddagal. Right? So those things. Porters, FIFOs, and lessees. This is the Porter's FIFOs model. We look at the market based on market or a business based on these 5 factors. Right? Rivalry, competition among the industry players. Right? So you have a market where you have few big players. You heard about monopoly, monopolistic, oligopoly, all those things. Right? So if you are very big, you have equal powers. But maybe some markets you have 1 or 2 big players, but several small players. What is the competition? What level of competition? Right? Oh, all small players. That kind. What kind of competition you have? Right? When you have very large competitors and you are also playing in the market, it is very dangerous. I'll tell you example. From the banking industry itself. There are some big banks which can lend at the very rock bottom rate. So a smaller bank will never be able to lend housing loans. We say one bank is lending at 8% or 7% per annum. These are hypothetical examples, right? 7%. But other smaller banks, their cost may be 7%, so they will not be able to fund housing loans. So they will lose their market share. Once I met a shoe manufacturer, right? He was ready to run at cost for 2 years to wipe out the smaller competition. So everyone can't face that kind of a thing. So you have to be careful whether you have a big players or small players, your size players. When you have your size all players, competition is bearable. But when you have big players and small players, competition may be very, very high. Right? So you have to look at the competition. Then you have to look at the dependency on suppliers. Dependency on suppliers. I am manufacturing this pen. The raw material I use is not easily available in the market. I have 1 or 2 suppliers maximum, 3 suppliers maximum. So I depend purely on them to supply me the raw material. So I am at the mercy of these 3 suppliers. If they don't supply, right? If they don't supply, I will go out of market. I will go out of market. Give me 1 minute, please. I'm depending on this supplier. If they increase the prices, I don't have option. I can't go to any other one to buy. Right? So, dependence on supplier is a very risky and critical factor. Then dependency on the buyer. I am producing this pen only for few buyers. Right? Then it is very dangerous. If my buyer stop buying from me, what can I do with this pen? I have not tried anyone else. Once I had a customer who was manufacturing this bite items, murukku and those bite items, right? She was selling everything to one person in PETA. I told her, you are running a risky business. You are depending purely on me. No, he's like a brother to me, and whatever I produce, he buys. So purely because of that factor, we didn't finance her. After a few years, I found her. She has lost everything. She has lost the entire business. Why? The buyer himself has started a production line to manufacture these items. So he has stopped buying. So he was purely depending on buyers. So dependency on few buyers is a risky thing. So you have to look at the dependency on the buyers. Then the new entrant. How easy is to have new competition? Can new people come into the business, especially countries like us? If I have a clothes shop today here, within a year, the entire road will be clothes shops. So easily, people, whenever there is a successful business, someone else will come and start the same business. Right? So how easy for the new entrants? Is there any barriers, capital expenditure, laws, anything? Then the substitutes. Can this product be substituted? Instead of this pen, is there any other cheap way of using? Instead of cameras, can we use a mobile phone? But instead of a mobile phone, you can't use a camera. But you can use mobile phones. Do you need a computer today? No, we have other things, tablets, smartphones, which will do what you want to do with a computer. So everything substitutes. Right? So this is the model we used to look at the market and the industry. What is the industry rivalry? What is the dependency on the supplier? What is the dependency on a buyer? New entrants and new competition and the substitutes. So whenever you are analyzing a market, you can use this model. Right? So this is the model. We have 5 force model. Industry competitor, rivalry among competing firms, bargaining power of the supplier, bargaining power of the buyer, threat of potential. 1 minute, please. Right. Okay. Custom bargaining power of buyers, bargaining power of suppliers, new entrants, threat of potential new competition, and threat of substitute. Right? These are the detail what I explained to you in writing. Rivalry, number of competition, larger or few competitors are not similar in size, suppliers, number of suppliers, buyers, new entrants. Right? Substitute products, quality of substitute products are not readily available, price of substitute, like you may be having a substitute product, if the quality is not good, you don't have to worry. If you have a substitute but price is very high, you don't have to worry. So like that you can have. Okay, thank you. And we under this chapter we discuss few things. Where we right. So here we discuss consumer credit, commercial or development credit, and international trade. We have discussed earlier. Right? Consumer credit is the what? Funding, but no new income generation happens with credit. Mainly we look at first we look at the 6 C's of credit, then other versions are papers, passes, and Campari. These are models we use to evaluate consumer credit. Then corporate credit, we use MEFERT, M-I-F-E-R-T, MEFERT, management, industry, financial, those things, right? We discuss these factors, financial ratio, this profitability, risk, and terms and conditions. Risk, these are different risks. Then you have terms and conditions, different types, positive and negative. These are the things. Then security, value of collateral. I told you the collateral thing. SWOT analysis, then we discussed the PESTLE. SWOT is for the industry micro, and PESTLE is the macro. Then Porter's 5-force model. 5-force model looks at the competition, suppliers dependency, buyer dependency, new entrants, and substitute. Right. Okay, that's it for this week. We will meet again next week. Thank you.